This is Grim. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a crisis unleashed as this could spark the next financial meltdown. And when you understand what it is, it will make perfect sense why we're on the brink of another financial crisis, because this event has preceded every modern day financial crisis in history, and it's happening right now. Plus, we're seeing an increase in demand from the U.S. consumer, but we're going to show you why it's about to come crashing down. And while the Fed keeps talking about rate hikes, I'm going to show you what's going to put them on ice faster than even they expect. And if you're wondering what we're doing in China today at the World Financial Center, well, we got a bird's eye view of where the next global financial crisis is about to begin. Let's go to Bloomberg, where we picked today's story up with a headline: China's property stocks slide to the lowest since 2011 as rout extends. And this is dangerous because you remember, a lot of these companies need to keep their stock value up so they can continue to raise capital and get money. And what have we heard recently? That Evergrande missed the payment on their bond. The last thing that they need is to see the entire sector come crashing down. We told you this was going to happen, where there's one cockroach. In this case, there's a whole bunch of them, and they're all called the Chinese property market. The South has now erased all of the sector's gains since China's reopening rally took off at the end of October. Investors are bracing for further troubles and some distressed builders after policy support failed to drive a sustainable recovery in home sales. While developers are counting on the Golden Week holiday to revive sales momentum, a stream of negative headlines on the sector's distress may keep buyers away. I don't think it's going to be may keep buyers away. I think buyers are going to run and flee from the property market, because when you see in the news that the biggest developers are having trouble and failing, they can't make their payments, is there any hope that if you go and buy a property that they're actually going to complete it? The chance is nothing. And yet, what do we hear from Beijing, the government, central bankers? Oh, we'll just cut rates a little bit. We'll give you a little bit of incentive to go buy something, as if they think consumers are dumb. Well, I got news. They're not. Watch them turn their backs here, and that'll be another nail in the Chinese property market's coffin. The government will eventually provide some solution to Country Garden and other failing or failed developers. If not, it would be difficult to boost housing and investor sentiment. No question about that, except I think Beijing's going to come in, direct stimulus, direct bailout. They have no choice. These developers are insolvent. That means their banking system is insolvent. We see the developer goes, the banks fall, and that spreads all over the world. There's no way that if China wants to be the superpower that it hopes to be, that it can allow something like this to happen. Watch for it. Direct bailouts are coming soon. Meanwhile, the broader market advanced as the country's industrial profits rose for the first time in more than a year, pointing to signs of stabilization. Of course, there's always hope right now, even though we're about to see demand across the world roll over and head down, and yet everyone is just fixated on these just tiny little increases in the data in hopes that maybe, just maybe, this is a mythical soft landing. But as you're about to see for China and Evergrande, things get worse as China puts Evergrande's billionaire founder under police control. And the move is the latest sign that the saga at the world's most indebted developer has entered a new phase involving the criminal justice system after authorities earlier this month detained some of the staff at its wealth management unit, and two former executives were also reportedly held. It adds to the questions over the fate of Evergrande after setbacks to its restructuring plan in recent days, roiled financial markets, and raised the risk of liquidation. Now, could you imagine if the U.S. government took a major CEO and put him on house arrest? That would cause major panic of what is going on. But here's the real issue. Let's talk about Evergrande. The word liquidation continues to come up. And what that means is you take its assets and you put them out to the highest bidder. It's called a fire sale. And this, well, we know what will happen. There's going to be a massive haircut. The banks are going to get burned. The investors are going to get burned. Everybody that's got their hand on this company is going to get burned. And then once we find out what the real value here is, this is no different than the U.S. commercial real estate market. As soon as we find out the real value, you're going to watch a whole bunch of banks fold. The same thing will happen in China. We'll see if Beijing avoids this, but I think if they go to liquidation, watch out. Then the spark is going to turn into a raging fire. And now let's turn to the U.S. as business equipment orders are rebounding after a downward revision. We see capital goods orders rose 0.9% after falling 0.4%, suggesting that perhaps maybe the soft landing is indeed here. I'm going to make the case why it's going to come crashing down harder and faster than any of the policymakers think. The value of core capital goods orders, a proxy for investment in equipment that excludes aircraft and military hardware, rose impressive 0.9% after a downward revised 0.4% decline in July. Bookings for all durable goods, items meant to last at least 3 years, climbed a mere 0.2% after also the prior reading, get this, was revised lower. Excluding transportation equipment, orders advanced 0.4%, but notably the data isn't adjusted for inflation. So you know what I think we should do? Let's adjust it. Here we have manufacturers' new orders durable goods less the consumer price index. We're talking year-over-year rates of change subtracted from each other, and now we get a clear picture here. Going into the dot-com bubble, you can see on an inflation-adjusted basis, new orders were outright collapsing. You can see below the horizontal black line, that means they're going negative. It was very clear there. How about going into the global financial crisis? Here's that hope of the soft landing. Look, the Fed drives up rates. You see orders come down. They bounce back up. Everyone says, hey, look, we got it. This is it. Nope. And off the cliff they go. Let's head over to 2015 and 2016. Remember, we were headed into a global synchronized recession and it was averted. But look at this. You see new orders adjusted for inflation, negative. They did rebound and pick up, but here we are again. We see the downturn. There's the soft landing. The reality is this is coming crashing down. I'll show you why in a moment. The increase in orders was led by computers, electrical equipment, and machinery. Total durable goods bookings were boosted, get this, by a roughly 19% increase in military aircraft, and that will do a lot for the data. In this case, it absolutely did. But why are we going to see new orders come crashing down? It's all down to one thing. It's the only thing that matters in a debt-based economy. It's the creation of new debt, and when the banks curtail it, well, then all of a sudden, eventually, we run into a wall and everything comes crashing down. Here you can see manufacturers' new orders of durable goods is adjusted for inflation, still shown in blue, and gets the net percentage of domestic banks' tightening standards for commercial industrial loans to firms of all sizes. And here you can see as banks are tightening standards here, notice the new orders didn't really slow down because it takes some time for that money in the economy to get eaten up against the fact that the banks are curtailing the creation of credit. As soon as then it starts to accelerate to the upside, new orders accelerate to the downside. You see the same effect in the global financial crisis. We can notably even just see a little bit of it here during 2015 and 2016. Even though banks were on net, were still fairly loose in the onset, validating we indeed were headed into a global recession. And now we're seeing the same effect. The problem we have is there was so much pandemic money still in the economy, and absent, we know, the student loan repayments, there was an effect that consumers did have money to spend, and that's why we're going to hit a major wall here in a matter of months as money dries up and goes away. With something else that's drying up, well, there's a lot of tanks in Oklahoma. Here we can see as WTI extends gains as Cushing stocks near tank bottoms, and now we have the official data from the Department of Energy. What we see is crude oil inventories down 2.2 million barrels. Cushing, that's the one we really are watching here, down almost a million. Gasoline inventories up 1 million. Distillates up 400,000. That's your jet fuel, my friends. Let's take a look here because we're seeing bottoms. This is not good. We saw it in 2014. We saw it in 2018. And again in 2021, going into 2022, we're back again. This is a dangerous sign because what it suggests is that crude oil prices are indeed going higher. And when we talk about, industrialized economies, expanding economies, there's one key thing you really need, and that's cheap, plentiful energy. So here we're at a time when consumers are already pinched. They're facing the student loan repayments coming back. They're getting those lags of monetary policy and higher interest rates on their credit card minimum payments that they're maxed out already on their cards. Their pandemic stimulus is gone. They've drawn down their savings, and now they're facing a difficult situation as energy prices rise. And between that, food and rent, that means discretionary spending goes down. And that's why yesterday we saw from the conference board, remember, consumers' confidence, the outlook would drop down. Why is that? Consumers know what's coming. They know layoffs are coming soon. But one thing that should be going up and not hitting a bottom Well, that's your trading account, but just check this out. We finally, Schwab updates our trading platform so we can get the missing day on 8/31. We're going to show you right here. This is where our reports triggered it. They said buy here on 8/31 at open, up 13.7% on crude. This is how easy it is because we do two reports. One runs a machine positioning report and then runs a historical overlay. There you can see August 31st, they went and flipped and bought under that upside move. That was confirmation number one. Now confirmation number two comes from our Momentum Timer Pro report. Now $20 a month. You can lock it in that price and get a whole month free right now. Coupon code in the description below. Look at the energy sector, XLE, XOP, ETFs in the energy sector. 3 consecutive daily momentum signals, 4 on this one. I got an email from a subscriber to both. He told me, Steve, I've been trading all my life and your two reports make it so easy. When I see them confirm each other, I buy, and they both can be yours. Link in the description below. 14-day money-back guarantee if you're not satisfied. Let's check this out. As bankruptcy soar, debt market tightens. They're warning the default cycle has started. Now you think about this from a debt-based economy. What do we need again? New money created. We need a lot of new money created, not just from the growth aspect, but to pay on all the debt. So the more debt you have, the more future growth and money you need. So when the Fed comes along and inverts the yield curve, curtails that creation of money, we get this effect of what's called a game of musical chairs. There just isn't enough money or chairs for everyone that needs them. So what happens going into a financial crisis, you start to see delinquencies start to build, and then they turn into defaults, or you get bankruptcies. It's all signs of one key factor here is there's not enough money to keep the economy going. And at some point, the entire system breaks, as you're about to see. And so in the latest report, we see Michael Hartnett, this from Bank of America, one of the most bearish analysts, especially there, is saying, look, we got problems. And look at this, personal savings rate says going up. But notably, high yield defaults are up 1.6% to 3.2%. Credit card delinquencies, this is a problem, jumping from 0.8 to 1.2%. And auto delinquencies are surging from 5 to 7.3%. This is how you know the system is running out of money. This is like driving your car, you're trying to get to the gas station, the needle's on empty, the engine's starting to sputter. That's what we're seeing here with the economy. And as soon as it runs out, the car dies. The U.S. economy coming now in a matter of months. And speaking at the Bloomberg Global Credit Forum in London, these titans of the debt world warned of looming headwinds and widespread defaults as the impact of higher interest rates slowly filters through consumers and companies, as some $4 trillion in investment grade and high yield debt has to refinance at sharply higher rates in just 2023 and 2024, suggesting, and what they're trying to make the case is, look, these companies can't pay those higher rates. Granted, we know that's true. The real question is, can they even get them to those loans refied? Because will the banks extend them the credit, or will they say, hey, look, you've got to pay your loans down. You've got to cut headcount. You've got to show us more profit. You've got to do something, because we can see here that when the banks curtail credit on step, the delinquency rate goes up. We've got the delinquency rate now here of all loans at commercial banks in blue. That's shown on a year-over-year rate of change against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. Notably here, you see above the black line, that's when banks are tightening, and of course, delinquency rate goes positive. Notably, when it's above their delinquency rate, showing a positive trend here in 1990. But how about this, 1998? What do we see? Banks tighten lending standards. Shortly thereafter, delinquency rates go up. And why does that happen? The system starts running out of money. You see that happen almost in tandem, starting around 2006, 2007. We see it again right now, that there's so much pandemic money that was in the system. We didn't see the delinquency rate move that much. Watch in the future reports. We're going to see it outright jump. And one thing that is jumping is bankruptcy filings this year are moving higher, and that's an ominous sign as companies again are running out of money. We keep seeing this sign over and over again, and this is just a matter of time before the machines of the economy come to a screeching halt. But of course, we know the Fed's going to keep raising rates until I show you what's about to put them on ice. But as we look at commercial industrial loans, this is the backbone of the economy. This is what's greasing the wheels of keeping these companies in business, borrowing money. And we know, we sold you this on last week's data. It was at 0.1% year over year growth, and that's about to go negative. And the key thing is when you see this blue line go negative, you notice what happens. We're either in a recession or we're going into one of the two. And because why does that happen? Remember, when commercial banks originate new loans, money's created in the economy. As loans are paid back, the principal part of any payment is destroyed. That money's removed from the economy. So when this goes negative, what it means, there's more loans being paid off than created. On net, money being destroyed. Bad news. That's why we always see this. That's why you're seeing these delinquency rates go up. That's why you're seeing bankruptcy rates go up. And if you think they're done going up, wait till this thing goes negative. They're going to skyrocket. As U.S. mortgage rates climb to 22-year high of 7.4%, again, curbing demand. Again, we keep looking. Where are people going to borrow these higher rates that the Fed thinks they're going to? So far, it's not happening. That is a sign that the economy is not growing at the pace the Fed thinks. Here we can see the contract rate on the 30-year fixed rate mortgage rose 10 basis points to 7.14% last week. And as a result, the index of home purchase applications fell to 144.8. What matters here, one of the lowest readings in decades. Despite what we're being told is a housing shortage, what we're seeing is people can't borrow money. They can't go out there and get it. There's a money shortage problem in our economy. So even though there's people that want homes, they can't get them. And it's not just those that want them. We're also seeing those who have them can't get money out of them either. As builders have stepped in to replace housing inventories and have been offering incentives to attract prospective buyers to the new construction market. But there's only so much demand they can attract when borrowing costs are high. And of course, what's missing here is banks don't want to lend. And the overall measure of mortgage applications, which includes refinancing activity, also declined. Of course, we know homeowners just don't want to refi at these higher rates and possibly can't. And some of them being forced because the only place they can access money. Their credit cards are maxed out. The banks don't want to give them any more money on their personal lines. Where do you go? Where do you have home equity? That's right. You go there, tap the money out. But boy, it's going to be expensive. But now the Fed keeps talking about higher rates. We keep talking about lower rates. The Fed, I'm going to show you what will put them on ice real quick. The Fed may do less if risks like a shutdown hits. That's from Kashkari, and he's right, because if these downside scenarios hit the U.S. economy, we might then have to do less with our monetary policy to bring inflation back down to 2%, because a government shutdown or the auto strike may slow the economy for us. He's not hoping for that, he said, but there's an interaction there, and he's got this right. Any effects at this point that cause the economy to slow down, the Fed will immediately go to pause mode because they will panic. And what they're going to find out is they're going to suggest it had to do with the strikes, or it's going to have to do with the government shutdown. They'll use it as their scapegoat. Watch, because you've seen on the show, the data suggests where we're headed. But the Fed always needs an out to get out of this. If you don't think they're hoping for a shutdown right now, you better believe they are. In the letter published online on Tuesday, Kashkari, who votes on monetary policy this year, outlined just two scenarios. We'll tell him he should have been a third for the Fed's inflation response. And one to which he assigned a 60% chance the central bank can give inflation down to target without causing severe damage to the economy, which we'll say should be about a 0% chance. In the other, price growth would be more entrenched and require further rate increases to bring price growth under control. We'll also assign a 0% chance to that. Instead, assign a 100% chance that the Fed does what they do best and drives the U.S. economy and the global economy not just to a recession, but an all-out financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.